Hello and welcome to Trading 5 Talents. In today's video, I want to go over a really interesting trade setup called the Iron Condor. So what is the Iron Condor? It's actually two different credit spreads with the same expiration. So it's selling a call credit spread and a puts credit spread at the same time, but with the same expiration. And this is entered for an overall net credit. But because each of these credit spreads have two options involved, or two legs involved, this is actually a 4-option strategy, or a 4-legged strategy. So we're going to use American Airlines, AAL, the ticker symbol, as our example. So over here on the left, you can see that we are using calls in this example. So this is going to be a call credit spread, and then the expiration is May 27th. So we know this is a credit spread because we are selling a call we're selling this 17 call for 77 cents, and we are buying this 18 call, and it says you've already selected to buy this option. So 77 cents in credit, 44 cents in debit. This would be a net 33 cent call credit spread. Now, on the opposite end, we are going to be doing a put credit spread. Same expiration, May 27th. And here we are selling a put at $15, at the $15 strike price, and we're selling it for 61 cents in total credit. And we've already selected this one to buy this $14 strike price. So 61 cents in credit, 39 cents in debit. That would be 22 cents in total credit. So that would be these two spreads combined together. And what that equals now is a 55 cent credit, 22 cents plus the 33 cents. Now, the reason I've got these two screenshots here is because you couldn't see all 4 trades at one time. So this $15 strike price in put is the same as the 15 put right here. And so this would be the 4th leg. So here with the calls, we got to sell and we got to buy. This is our call credit spread. And here with our puts, we've got to buy and we've got to sell. This is our put credit spread. All of them have the same expiration date. Of course, all of them are on the same ticker. So this is the Iron Condor, 4-legged strategy entered for a net credit. So using this American Airlines as an example, we'll look at the schematic and how this is set up. So our price line, left to right, lowest to highest, this is where the stock is currently trading. What we're first going to do is we're going to enter this call credit spread that we just pointed out. We're going to short the 17 call, we're going to sell the 17 call, and then we're going to buy the 18 call. And so that's the long side of the price line. So this is a call credit spread. And then we're going to go to the other side with the puts, and we're going to use the same expiration date, but now we are selling the 15 put, and then we're buying the 14 put. This is our put credit spread. So this is what it would look like. In summary, we just looked at these numbers here, but once again, the call credit spread would give us 33 cents in premium because our short premium is more expensive than our long debit. And then our put credit spread would also result in a net credit of 22 cents. So added together, 55 cents in total credit is received. There are different ways you can construct this Iron Condor. You can construct it in a bullish way. So if the current market price of the shares is right here in this dotted vertical line, basically with an Iron Condor, you want the stock price to expire somewhere between your short strike prices. So somewhere above your short put and somewhere below your short call. So anywhere in this area, you're going to receive your maximum profit. So if you think that the price of the stock is going to go up slightly, then maybe you can construct your Iron Condor like this, where your puts are closer to the market price and your calls are further away. So the stock has some upside room to move. That's if you're bullish on it. If you are neutral, you would construct your Iron Condor sort of equidistant from that current share price, just like this. And then, of course, if you're bearish, then you can put your calls closer to the money or closer to the current share price, and then it gives some room to move to the downside. So as long as it expires somewhere between these short strikes, that's when you're going to receive your maximum profit. So here they all are on a single page if you wanted those for reference. Now, the profits and losses with the Iron Condor, because these are spread trades, once again, profits and losses are going to be capped, and they're going to be very well defined with an iron condor. The max profit is achieved if the stock price expires between the short strike prices at expiration. So that's why I was saying you can make it bullish or bearish or neutral depending on how you position those short strikes around the current market price. So for the iron condor, the max profit you can make would be the credit that you're receiving once you open the trade. The max loss is the width of the strikes, the maximum strike width, minus the credit. So let's look at this right here. We set up a call credit spread with this iron condor, just one strike apart, 17 to 18. We also set up a put credit spread, also one strike apart, 14 and 15. So these are both the same widths of strikes. It's only $1 wide strikes. Now, if one of them was $2 and the other one was $1 width in strikes, then you take the max width minus the credit you received, and that's the max loss. But because these are the same, it would just be the width of the strikes, $1, minus the credit you received, which is 55 cents, and that would be $45 as your max loss. So let's take a look at OptionStrat, and we will delve a little bit further into the iron condor. All right, here we are at OptionStrat. Link is down in the description. Again, this is just using the free version. I'm not a member. I don't pay for anything on this website. I just use it for this build feature. So we are going to be looking at an iron condor right here under neutral. Again, at the bottom, you can see the basic setup. So let's click on iron condor. And we are going to use American Airlines, ticker symbol AAL. And we want to set it up just the way that we had it in our example. And I believe it was May 27th, and we had the 14 and 15 put credit spread right here, and then we had the 17 and 18 call credit spread right here. All right, current stock price of American Airlines at the time of this video is $16.68. You can see that here by the dotted line. Now, if we zoom out, you can see the profit and loss profile for an iron condor. And basically, your max profit is achieved if the stock expires within the short strikes. So in our case, between 15 and 17. Anywhere between 15 and 17 is our max profit range. Once you get beyond your long strikes, so in this example 18 and also 14, once you're beyond your long strikes, that's when you're going to have your max loss. And you can see in this case it's $44. This is a really nice strategy because you can elongate these wings of the iron condor. You can separate your short strikes a little bit more and gives you just a little bit more room to be wrong, as long as the price stays within those short strikes. Now, let's look at days until expiration and see what happens as we approach expiration. So, of course, what you're seeing here is expiration Friday, but if we were to go all the way back here, and this is where our trade started, and you can see that the current market price is there in the vertical dotted line, and as you get closer and closer, your price can move around and your profit profile only increases as you approach expiration. So when I make trades, I don't generally hold them until expiration. I'm trying to exit them as soon as I reach, a certain profit target. Again, anywhere from 50 to 90%. What you don't want to do is you don't want to hold on just for the last few dollars and then you have a sudden shift in the price and it breaks one of your wings and now you're going to turn a winner into a loser only over a few dollars. So what I would recommend is simply just exiting early, closing this out. But you'll see one of the disadvantages is that it could increase commissions or fees because you've got 4 options to manage here instead of just a single one. So what happens if you, let's say, widen out the wings? Well, let's move this down to 13 and this one down to 14, this one up to 18 and this one to 19. And so now you can see your max profit is $33. That's the credit you're going to receive. The max loss is $67. So as you give yourself more room in terms of a profit profit range, you are going to decrease the amount of profit that you're making. So I like this website because it gives you a pretty good, or at least an easy way to visualize how much profit you could make or potentially make with any given trade. For example, if you believe American Airlines is going to go down further, you can tighten this, 17 to 18, and you can drop this one down a little bit more. And now you've made this a more bearish play, and so it's got room to move down, and you still retain max profit. So some tickers have 50-cent increments in their strike prices. So right now, 12 and 13, that's one strike or $1 wide. 17, 18, that's $1 wide. Now, if you were to move this, let's say to 1850, so here's where your max loss is a little bit different. Okay, so now you've got $1.50 between your strike prices. So $1.50 minus the credit you received, that would be $93. That's your max loss now. All right, so that's how you calculate your max loss, is whatever strike distance is greater. In this case, it's the green calls. Whatever strike distance is greater minus your net credit, that is going to be your loss or max loss that you can sustain. Right, so that's how the Iron Condor is set up. So let's finish up this discussion of the Iron Condor. And we'll do that by looking at the advantages and disadvantages of using an Iron Condor. So as you can see, the max loss was pretty small, and as is the max gain. But because of that, because it's a spread, actually a combination of two spreads, it's great for smaller accounts. You don't need a lot of capital to put these types of trades on. So the amount of money you do need, though, is simply the max strike width. In our case of American Airlines, it was $1 width on both sides, so we would just need $100. If you increased it to $1.50 wide strike on one side, then you would need $150 to put this trade on. So here you can still sell options premium, but you can use a lot less money to do it, which is why it is very popular for beginners that are interested in selling options premiums. It limits your downside risk because of the combinations of the spreads. But the disadvantage for the Iron Condors is that, one, like all spreads, you cap your profits, which again, to some people, that's not really a disadvantage. To others, it is, but I'm going to list it as a disadvantage here. And another major disadvantage is that you're going to have longer fill times for your orders. And that's because instead of just opening a single option position, you now have to open 4 simultaneously. And once all 4 are opened, trying to close them can also take some time because you have to close 4. So what you could do if you wanted to trade an Iron Condor and you're concerned about this, one, find, high volume stocks, a lot of open interest. But the other thing you could do is you can open up a call credit spread as one transaction and then open up a put credit spread as another transaction, and then combine, the credits for your Iron Condor that way. Just one wing of this Iron Condor at a time if you're concerned about these fill times. But because you're using 4 options to create this type of trade, then that is going to be more commissions. I mentioned that earlier, but that is a disadvantage if you're paying commissions for every time you open and close an option order. You also saw from the profit and loss graph that really large moves can have a negative impact on the Iron Condor, because if it breaks your long strike on either wing, then you're in max loss territory. So you don't want a wide move. You want something that is going to, or you believe is going to stay within a narrow range. So as long as it stays within the short strikes, you're max profit. As soon as it breaches your long strikes on either wing, now you're in max loss area. So if you feel like something is going to move, very violently to one side or the other, you can also use a reverse Iron Condor, and that's just the opposite of what we went over now. So your max loss is in the middle if it stays within a range, and your max profit is if it breaches that range. So it's just the opposite of the way the Iron Condor is set up. And on OptionStrat, there is a strategy, reverse or inverse Iron Condor, that you can take a look at and you can experiment with if that is of some interest to you. So if you have any questions about iron condors or about credit spreads or options trading or selling premium, then go ahead and leave a comment down below, or you can ask me on Twitter at Trading5Talents. And in the meantime, if you like this video, give it a thumbs up. And if you want more videos about option selling and trading strategies, then go ahead and click on the subscribe button and turn on the notifications so you can catch all of those updates. Until next time, trade wisely and take care.